Welcome everyone, and thank you for joining our webinar today. Today's topic is private equity in orthopedics, before, during, and after the transaction. A few quick things to keep in mind. All attendee lines are muted throughout the presentation. At the end of the presentation, there will be time for questions. You can ask the questions by typing within the Q&A section, which is located in the control bar, most likely at the top or bottom of your screen. This webinar will be recorded, and it will be distributed later this week. Today's speakers include Daniel Fryer, the founding partner at Fryer Leverett, and Robert April, a senior associate at Provident Healthcare Partners. I will now turn it over to Robert to give a brief introduction on Provident.
Thank you, Gina. Provident Healthcare Partners is a healthcare services-focused investment bank, and really what that means is that we service our clients and advise them through transaction processes, really beginning with the initial education around what a potential transaction could look like for the shareholder group, all the way through to the negotiation and ultimate close of a transaction. We specialize primarily in the physician world, everything from your ophthalmologies, urologies, gastroenterologies, and then specifically to this conversation, orthopedics. We've closed just over 50 physician deals, 5 of which were in the orthopedic space. So everything from the practice side to the surgery center, and then also dealing with transactions that involve both the practice and surgery center side. And now I'll give it to Daniel for a quick overview of his firm.
Good afternoon, everyone. This is Dan Fryer. I am one of the founding partners of Fryer Leverett. We are a national boutique healthcare law firm. We have our offices located in New Jersey, Manhattan, and in Long Island, and we service clients in over 40 states, specifically on healthcare-related issues. I personally have been involved in representing physicians for about 25 years in corporate transactional regulatory matters, and more recently have been involved with numerous private equity transactions of varying types, the formation of large supergroup practices. In fact, I'm speaking to a large group of orthopedic surgeons in February over in Newport, California. I have a lot of orthopedic clients, and I'm happy to discuss this with everyone today.
So the first question that we often get when we're sitting down with groups for the first time discussing what is with the recent wave of consolidation within orthopedics and ultimately the impending wave is, why are these transactions happening now, and why is orthopedics such a common topic when we think about these transactions, whether it's the strategic consolidation or private equity consolidation, which will be a major topic in our discussion today. And really what the biggest answer lies in where investment dollars have gone in the past. So when you think about who is doing this consolidation and who are these private equity groups that are making investments into orthopedics, it's the same groups that have made investments into the other ologies, the dermatologies, ophthalmologies, even dating back to the anesthesias and dentals of the world in the 90s, that are looking for other areas within healthcare services to invest those dollars. If you think about what a private equity group is, it's a pool of capital and a management team looking to deploy that capital in specific industries or sectors in which they are experts or educated in. So they'll have an investment thesis around healthcare services, and they'll look and weigh investment options in different sectors and look to find ones in which they think have a lot of industry tailwinds in. So just like a lot of these private equity groups targeted the pain managements and dermatologies of the world around 2010 and had a lot of success in those investments, as this slide shows, they've now looking to target what we're considering the second wave of physician services and looking at other sectors within the space that they can have similar results in finding strong physician leadership and strong physician groups in which they can invest alongside and help grow, as they've done in a number of other sectors, as we've shown here. What you can think about the difference between the second wave versus the first wave is really the surgical nature of it, the urologies, the orthopedics, the OBGYNs, where there's a large surgery center component and a lot kind of different of a service mix than certainly pain management, dermatology, where there's some cash components of it, a little bit more retail of a model versus orthopedics and urology where there's strong ties to the health systems. So that's why you're seeing most likely, these being the most recent spaces in which private equity groups are looking to invest dollars and weren't the first ones. Just the business model is a little bit more complicated. It's a little bit more clinical based. But now these private equity groups are educated. They've spent the last nearly decade, if not longer, working alongside physicians in other subspecialties and are looking to take what they've learned there and apply it to these new subsectors. So, and from a clinical standpoint, obviously orthopedics is very different from dermatology and ophthalmology. But if you want to think about it from an investment or a managerial standpoint, there's a lot of parallels and similarities. Multi-site physician-based businesses dealing with payers and negotiating payer contracts. You're dealing with ancillaries and the build-out of ancillary services around physician groups. So when they think about it from a higher level growth strategy perspective, there are a lot of similarities and parallels they can take from those past investments. And so that's why you're starting to see these private equity groups that previously invested in other sectors now start to turn their sights to this second wave, quote unquote, orthopedics being one of the big components of that second wave. On to the next slide. So dialing into the activity that we've seen in the marketplace. We did one of these webinars a number of years ago where there had only been one transaction that took place. And in that webinar, we talked about all the market dynamics that were setting up orthopedics to be really one of the more highly consolidated active marketplaces in the coming years. And what we've seen is that while it's still been a little slower, we have seen a number of transactions take place, 9 to be exact, since 2017. So again, those market dynamics continue to exist. The aging population and the demographic shifting towards the need for quality musculoskeletal care continues. On top of that, you think about the shift to outpatient services, the shift away from the hospital system as CMS continues to approve more complex surgeries being done in a surgery center. That only intensifies the interest that these outside investors have because there's more of that patient care and more of that comprehensive care being shifted to these private practices and outpatient settings that continue to create this thriving marketplace in the broader orthopedic world, which only intensifies, again, that interest that these outside investors have. So if you think about the investments that have been made in the space, you can see that there's been a number of larger scale orthopedic practices, especially in 2019, that have started to see private equity as a really thoughtful and really strong strategic initiative to take and really bringing those outside capital dollars and capitalizing on being early movers here in the marketplace, because as we look towards the balance of 2019 and on to 2020 and beyond, we only expect the number of these groups to intensify and increase as more physicians and more physician groups become educated on what private equity is, and ultimately more private equity groups continue to become smart in the space and look for strong quality groups in which they can partner with. On to the next slide. So that's kind of what's been happening within private equity with the activity within orthopedics. But the question we get oftentimes is, why are physician groups going down this path? Why do physician groups bring in outside capital? Why do they give up a majority interest in their business? Why are they allowing these quote-unquote investors to be a seat at their board, right? It's a very common question that we get from nearly every, not only orthopedic group, but physician practice that we work with. Because the reason why physicians go into private practice is their need and desire for autonomy. That's why they didn't join a health system. They want to be able to control their care to patients. They want to be able to control the business that they either started or joined or have a large part in creating and growing over the years. And so it's a big undertaking to convince a shareholder group or for a shareholder group to come to the realization themselves that it's now they've reached a point where bringing that outside capital and that outside expertise into the practice can actually be highly beneficiary for the practice. And so the way that we think about it when we're trying to help physician groups determine whether this is the correct path for them is dividing it into two buckets. The first being the practice or business components of this decision. Does this make sense from a business perspective for the practice? So when you think about the business side of things, private equity can come in and help with growth. It can help capitalize a number of things within the practice from a growth perspective. You think ASCs, you think expansion of locations, it can help with recruitment, it can help with add-on acquisitions. And then it can also help with not only just the recruitment of physicians, but it can help with the investment in the back office infrastructure. A lot of the physician practices and orthopedic practices that we work with are lean, mean machines. They have CEOs, they might have a CFO, but more or less those different folks hold a lot of different roles within the firm or within the practice, and as it grows, they're stretched very thin because of those hats they wear. And because practices typically aren't going to build out a huge suite of C-level folks, private equity groups can help recruit those folks and build out that back office so that as the practice grows, you have that managerial team in place that can really help support the physicians as they grow the business. Because all of this is about supporting a physician base, not replacing them. And so the second bucket I mentioned really is the personal decision-making process. Because while this is a largely business-driven decision on whether it's right for a practice, ultimately, whether the practice has 10 physicians, 20, 30, those are 10, 20, 30 individuals within the practice that need to come to the decision that this is right for them individually, because there are changes in compensation. Whenever you're doing that, there is that inherent risk as you as an individual that's providing income for your family that needs to decide whether this is right for you. And so that's the other large decision-making process is, sure, I see why this makes sense for the business, but does this make sense for me as the individual physician? And why so many physicians and so many orthopedics have come to the realization that this makes sense for them is because it allows them to take some risk off the table. Today, if you're a partner in a private practice, you own 1/10 or 1/20th or however many physician partners there you have of that practice. And ultimately, the value of that is the benefit of whatever distributions you receive from the ancillary services. You might receive increased compensation, or likely do, for being a partner. You're compensated above and beyond what an employed physician is because you bought in, you're a partner, and you share in that upside. And ultimately, the value there is the culmination of that upside this year, next year, so on and so forth, till you retire. You buy in when you first join, or a couple years after you first join the practice. And ultimately, when you retire, there might be a small buyout. You might receive your accounts receivable, more or less. It's not a big windfall of cash when you retire. So really, the value is the culmination of all of those increased earnings over time. And so what these transactions allow you to do is actually say, I'm going to receive some of those today in the form of a cash sale event. I'm going to take some risk off the table that the reimbursement environment changes down the road, that there's some dramatic shift in how payers view paying for my services. I think if you think about and talk to most orthopedic surgeons around the country, they acknowledge, or even some are very vocal around, there's a significant downward pressure, or at least somewhat of a downward pressure on reimbursement. So reimbursement in 10 years probably will look a little depressed compared to what reimbursement looks like today. And so there's the ability to take some of that risk off the table today for physicians and capitalize on that, and the ability to transfer some of that value in long-term collections and distributions and see some of it today, which inherently takes some risk off the table for them as individuals. And I think that there's a lot of physicians around the country that really latch on to that. So the next slide talks about what are the options that exist, because we've talked about kind of private equity as a high level, this investors in business and who they are, a pool of capital. But ultimately, that's not the only option for orthopedic groups as they sit and consider what their options are moving forward. So here, we just look to compare what those are. Ultimately, option one is always to remain independent. For the vast majority of groups out there, the best option for them truly is to remain independent. They've built a great foundation, or a great platform, and moving forward, the most logical thing for them is to continue down that path. They don't want to take the risk of ruffling the feathers, and they're content in which the platform and the footprint in which they exist. Option two is a private equity group. The majority of these private equity groups will look for a majority recap to acquire a majority component of the business. There are some that are considering doing minority deals, so less than 50% of the practice. Admittedly, those are fewer and further between. There's less private equity groups that will consider that. There are certainly some hits to valuation when considering a minority deal, but for the right practice, that tends to be or can be a deal that makes sense. But the majority of those private equity groups that you're going to see, those acquisitions that you see or read about, they're going to be a majority recapitalization. The rationale why is these private equity groups, that the selling physicians, it's not 100% buyout. They're typically anywhere from a 60 to 80% buyout, with the physicians themselves continuing to own anywhere from 20 to 40%. So the benefit there versus a strategic acquirer and outright buyout is the physicians participate in the upside. So when a private equity group comes in, invests in a business or a practice, and grows it over a 3 to 7 year period, which is the typical investment horizon, those physicians, you physicians that are still owners in the practice, benefit in that growth over 3 to 7 years. And so as the business doubles or triples in size, that equity value or that ownership can double and triple in value as well. And so there's the benefit there. The secondary component of the private equity world is the private equity backed company. So this is option 3 that we spell out. So when a private equity group invests alongside or into a physician group, they call that their platform investment. And nearly every private equity investment thesis in the physician world, and particularly in orthopedics, will be focused on building out that footprint. And one of the ways that they do that is through add-on acquisitions. So you buy a platform entity, and then through add-on acquisitions of the local market or a broader marketplace, you can grow the number of physicians much quicker than you can by just trying to organically recruit physicians to come to the practice. And so whether it's buying or acquiring a 5-physician practice down the road, or acquiring a 15-physician practice that is 50 miles away in a market that you're looking to grow into because you see a lot of favorable aspects of that market, add-on acquisitions are a very favorable way to help grow. And one of the benefits there is the physicians at the platform can help target the quality organizations and quality practices that would be great add-ons for the platform, and the private equity group can help structure and finance and execute on that transaction. So that's where really the partnership comes into play. And so that PE-backed company, what we're saying here is you can be an add-on acquisition. So for practices that are a little bit smaller, for practices that aren't quite the platform-capable groups that have the built-out management teams, but they still want to do a private equity-like transaction, have the ability to partner with a private equity or with a practice that's already received private equity funding and has a partner. The last of which option here is a strategic acquirer. 5-6 years ago, this wasn't quite an option for orthopedic practices. Obviously, hospitals were always an option and certainly a route that a lot of groups have gone, but for obvious reasons, many groups have been apprehensive towards going the route of a hospital system. Not only are the economics and financials much lower than any of the other options we've noted here, you ultimately become an employee of a hospital system, which is the complete inverse of what the majority of these practices' principles there were founded on. So the strategic acquirer we're talking about here is your larger industry operators like the Optums or SCAs of the world, the AmSurges of the world, Team Health. These are groups that traditionally operate in the physician sphere that are looking to diversify and invest into physician practices. Optum SCA is a great example of an area where they have a lot of different business lines that I'm sure most people here interact with to some extent, but are now looking to invest and look to partner with physicians in the practice. We've done a deal with an orthopedic practice that was acquired by SCA. We know that AmSurge, obviously one of the largest ASC consolidators in the space, is looking to partner with physicians on the practice side. So the ability for physicians to partner from a strategic perspective while still benefiting from similar valuation levels to private equity and have a number of the benefits of that while also seeing the benefits of partnering with a large industry operator, whether that's payer rates, best practices, you name it, that option is growing as well. So the number of strategic buyers is only increasing for orthopedic groups as well. So onto the next slide here. So we really went over a lot of this on the last slide around the difference between being a private equity platform and a PE-backed company, but I'll just kind of highlight a couple points. I think the biggest question that we get is, what is the difference between an add-on or a group that's an add-on profile versus a platform profile? And I think the biggest component really is size. Most private equity groups have constraints around what they can invest in. So they need a certain level of, or a certain size to be able to invest in that practice as a platform capacity. So really what that is can vary, but typically it's going to be practices that have 8 to 10 plus physicians and all the way up to the largest in the country. They're going to be practices that have invested into management teams, so they have a CEO, a CFO. They're not just operating with a practice admin. And these are rules of thumb, not always word of law. And typically they've invested in the full suite of ancillary services. They have physical therapy. They have imaging, MRI and X-ray. They have DME. Maybe they've built out a walk-in or an urgent care clinic, depending on state laws. So they've taken some of those proceeds over the years and actually reinvested into the growth of the business. And that's really a platform. An add-on is really a very still quality practice. They just don't quite have that size and scale to warrant being a platform. So a Ortho Bethesda or an ONS or a Orthopedic Institute down in Gainesville will look to acquire them as an add-on and roll them into their platform. And while it has similarly a number of the benefits of a private equity platform, it just opens that up to some of the smaller practices that aren't necessarily large enough to warrant that platform label, if you will. In the next slide, again, I kind of mentioned a lot of this in the last, but really this is really defines kind of what makes a strong private equity candidate. Again, the full suite of ancillary services, being in network with major payers is huge and something that we have to walk through with a number of our clients. Experienced management teams. Obviously, the things that go without saying are strong clinical reputation within the community, strong internal infrastructure, whether it's billing, compliance, finance, all the things that make a strong integrated practice are things that private equity groups look for in these orthopedic practices they're investing into. And then my last slide here is around, well, how do you pick a private equity platform, or how do you pick a private equity partner? Because at the end of the day, we spend a lot of time talking about private equity as if they're interchangeable or replaceable. But ultimately, there are hundreds of private equity groups out there in the world that invest into the physician world, and there's probably hundreds that are interested in investing into orthopedics. So it's important to understand that as you think about the private equity world, it's important to know that there are similarities between these private equity funds, but ultimately, they're very different from one another. Just as if every orthopedic practice in the country, there are similarities in the services that you offer, how you approach care, but ultimately, you're all very different and independent from the culture, from the mentality, from the personalities. All those things are things to consider as well when you think about a private equity group. How do they work with their physicians? How hands-on are they? Do they let physicians continue to run autonomously and only available when needed? How do they think about growth? What is their experience within the physician world? Do you like them? That's an under-commented component of these transactions is ultimately you're bringing a partner into the practice. Can you have dinner with them? Do you enjoy their company? Because ultimately, you're going to be working with them for 3 to 7 years, and can you stand working with these people? Just like when you're thinking about bringing a new physician into the practice, I'm sure there's some social component to it, to the recruitment, because you ultimately need to operate within a similar space as them. And so understanding whether you enjoy them and can trust them is a huge component of these transactions. And so the thing that we do is we always encourage our clients and help them through the reverse diligence in these transactions. Going and talking with the past groups that these private equity groups have invested alongside. Talk to the physicians that work with these private equity groups. Understand how successful they were in those investments. Understand what their returns were. Understand from a cultural fit, what do they believe in when they think about working with physicians? These are all things that we make our clients understand before closing, and ultimately you have to, because you're not going to trust your business with a private equity group that you haven't fully vetted. And so I think my closing comment here is just the understanding that each of these private equity groups is very different and unique and will each approach a transaction similarly, but from different perspectives and angles. And as you consider these types of transactions and whether they're right for your practice, it's important to understand that to fully understand whether it's right for the practice or not, you need to look at the sphere of acquirers or partners holistically and really narrow it down and find the right one for you if you're truly committed to going down this path. And now I'll turn it over to Daniel here for the latter part of the presentation.
Thanks, Robert. I think Robert spoke really well about some of the financial focus of private equity deals. And I have a lot of similar topics, but I'm going to talk about it more from my perspective as an attorney and someone who's been in the industry for years representing both platforms as well as add-ons, as Robert describes them. So the first question is why consider private equity? You know, Robert talked about it in a significant amount of depth, but I want to mention a couple things. Private equity should be viewed as a tool for physicians. You are essentially looking at private equity as one of several alternative processes you can go through to remain modern, to keep up with what's going on in medicine, and to sustain yourself for the years to come. And private equity is one of those potential solutions. There are alternatives to private equity. There are growth models that don't require an outside investor. I have many clients who have formed large group practices, super groups, so to speak, and who have chosen to stay independent and who have done quite well. A lot of the supergroup clients that I work with are considering private equity because it is a tool for them to continue to grow. A lot of large platform organizations reach a point where they reach a critical mass and organic growth is no longer easy for them. It becomes increasingly more difficult to expand without capital. And part of the reason for that is that when you've gone into a geographic region, what you'll find is there are early adopter physicians who will drink the Kool-Aid and buy into your platform and join without getting paid anything because they believe in a group, they believe in something that's going to grow. And then you'll find secondarily there are groups that you need to spend a lot of time convincing them to join. And by the time you've exhausted the first two categories and you're on to the third category has already withstood the pressures of joining a hospital, withstood the pressures of joining other large groups. And these are often very fiercely independent, sometimes not necessarily rationally independent, but sometimes, groups that are the hardest sell. But they often comprise what remains of the marketplace, especially in a fragmented market. And it's very difficult, if not impossible, to recruit those groups without capital. And a lot of my clients don't want to take capital out of their own pockets, and they don't want to borrow money. And private equity is a way, it's a mechanism to do that. Robert spoke about a retirement strategy, de-risking future income. I think those are all legitimate factors. I'll say one thing about de-risking future income. I believe that particularly with specialties like orthopedics, value-based care is going to eventually supplant fee-for-service, maybe not entirely, but it's going to supplant fee-for-service as the predominant reimbursement methodology. It just makes sense. And I speak with a lot of people in the industry and payers who are really not, who shouldn't even be looked at as the insurance companies anymore. They're really the big employer groups. But the payers, the big employers, are becoming savvy now that paying for volume is not working. It's just simply creating a bigger and bigger problem over time because the system just can't support payment in that way unless the physicians are incentivized to reduce costs and improve quality. So I think that's the direction, for better or for worse, I think that's the direction. And it's hard to engage, it's certainly hard to engage in value-based healthcare if you're a very small, unsophisticated practice, or even if you're a 20-physician, fairly sophisticated practice, you don't have the market share to go direct to employer and do those sorts of things. So why is private equity interested in, we can go to the next slide now, by the way. Why is private equity, I don't have control over this slide, so you're going to hear me say go to the next slide every once in a while, just forgive that. Why is private equity interested in medical practices? Robert went over that. But I think I look at it also, just to add on to what he said, as private equity doesn't have any specific interest in healthcare or any other industry. They're interested in generating money for their investors. And several years ago, the private equity industry, I'll call it, identified healthcare as an area of potentially huge growth. Remember, the institutional investors that invest in these private equity firms, like pensions or unions, they're looking for an alternative to investing money in the stock market or in the bond market, which has not been very good over the last several years. And so they're looking for something that will diversify their holdings and potentially give them a significant rate of return, understanding that there are attendant risks associated with it. The private equity industry has identified healthcare as a growth area, and I think physicians in particular, because physicians are so fragmented in many areas, that you could imagine having 100 different widget makers, all within a small area, a relatively small area of a state, all competing with one another, buying from suppliers individually, employing their own C-suite executives. The inefficiency associated with that would make it so easy for a large company to consolidate them, cut overhead, negotiate with suppliers, negotiate with customers. And that's, I think, the way that private equity views a lot of physicians. Now, not all marketplaces are fragmented. So you could have the most incredible medical practice around, but if the external factors don't meet the requirements of private equity, they may not be interested in you. The marketplace plays a big role, not just what you look like as a business. So I'll mention also, Robert also, next slide, please. Robert also discussed how do you identify a private equity partner. I'm going to add a few things to that. And I'm going to mention, and I'm not paid to advertise, but I will say that retaining an experienced investment banking firm is, I think, critical in many, many instances, if not all instances. I hear some of my clients coming back to me saying, oh, I have a friend who lives down the street, and he owns a private equity firm, or he knows a guy who owns a private equity firm, and so we're going to talk to that firm. That has to be the most inefficient way to go about this process. There are many, many private equity firms, and some of them will meet your requirements, and some of them will not. And negotiating with them as a physician group in an unsophisticated way is going to result in you getting a deal that probably is not optimal, and you'll probably end up with a partner who's not the optimal partner. The whole purpose of going with a broker or investment banking firm is to help structure your deal, prepare you for this process that could be a bidding process, and locate and identify a private equity firm that meets all of your requirements. And it's not, as we'll find out later on, it's not just about the money. It's not just about getting money in hand. There are a lot of other issues that need to be dealt with, and there's big differences between the different private equity players out there. The amount of capital that's available to that private equity firm is a big, big issue. I've seen deals suffer after the closing because the private equity-owned MSO didn't have the capital to expand, didn't have the capital to add ancillary services, and so the group never grew, and so which is one of the large reasons to do one of these deals, for growth and potentially a second sale down the road. The type of structure that is a very important consideration. There are private equity firms, for example, that will do minority deals. Most will not, but there are some that will. There are private equity firms that insist upon certain structures within the practice itself, which we're going to go over. Some of them require a lot more control over physicians, and some of them allow physicians to maintain a certain amount of control after the fact. You want to look at the private equity firm's track record. It's probably, all things being equal, better to pick a firm that has dealt with your specialty in the past, and they already have an MSO, maybe even a platform. So these are things that a company, a well-versed investment banking firm would be able to assist you with. Next slide, we'll talk about, I think, a really underlooked at and really critical process, and that is preparing for the PE transaction. I think what you don't want to do is start looking for a private equity firm, get interest, and then find out all the problems that exist within your practice that you never knew about that are going to reduce the multiple that you get from the private equity firm, because the multiple really is just it's a reflection of the risk that is perceived by the buyer. The lower the risk, the higher the multiple. The higher the risk, the lower the multiple, essentially, in very, very basic terms. So, and the other thing, there really is, what we'll talk about later, there's really two variables in the purchase price. There's the EBITDA, which is essentially the profitability of the earnings, which are kind of artificial in the case of a medical practice, and we'll talk about that, and the multiple. So if, let's say, you enter into a transaction and then you find out that your practice has upcoded significantly in ways that the private equity firm doesn't feel comfortable with, and they come to the conclusion that in reality you needed to code at a lower level, and that would have resulted in a lower EBITDA number. The purchase price they originally agreed to or discussed with you no longer applies because they don't believe in the future that they can bill for the services in the way that you've been billing for it. Some of the larger clients that I have, they do what's called a quality of earnings report. If you're a potential platform, one of the things that a PE firm is going to do is they're going to do a quality of earnings report. They're going to determine whether the EBITDA that you have is reliable, essentially. And so there are firms that will do a quality of earnings report, and I've had clients that will retain firms just to do a quality of earnings report before the private equity bidding process begins, in order to impress upon the private equity firms that you're sophisticated, that you take this seriously, and also to shorten the duration that it will take once you find that partner. And also to make their offer, to make the private equity firm's offer a lot more solid and trustworthy, right? If the offer is being made before they've done a Q&E report or before they've done a coding analysis, it's going to be less reliable, and it may change. I also recommend getting all of your organizational documents in order. I've seen too many times that practices are on the verge of signing documents when all of a sudden there's a dispute over what vote is required within their organization to effectuate that transaction, or how much each person should receive. Very few, I bet you very, very few of the people on this call who are physicians have corporate documents that specifically lay out how the consideration paid by a private equity firm would be distributed among the partners in a way that's completely defensible. These things need to be worked out well in advance of, I think, even starting the process of really talking with private equity. Another thing to consider is determining whether you are a platform or whether you are this add-on. They're also called tuck-ins. If you're very large, then you're probably a platform. If you're small, you're probably an add-on, but you might have an opportunity to become a platform. And what I mean by that is, if you're in a marketplace in which there are no platforms, or there are platforms that you don't want to join, just understand that you're, as an add-on, you're going to have to be added on to some sort of a platform. And two problems with that are, number one, you have less control over the transaction. Number two, you're going to generally get a much lower multiple as an add-on than you would as a platform. Because as a platform, you are essentially the entity around which the entire organization is going to grow. So I do have clients that, in anticipation of a potential deal in the future, have or are in the process right now as we speak, they're forming themselves as a platform through a merger of various practices in their geographic region that they're in, with the intent that within 1 to 3 years they're going to go to marketplace. Keep in mind, I've seen private equity interest even before a platform is fully solidified. So you can get doctors to sign an operating agreement. Potentially, you could get kind of the infrastructure started, get a tax ID number, start getting contracts, and go to market at that stage. There is potential to come out as a platform even without a lot of track record on that. And the last thing I'll mention about preparing for a PE transaction is, if you are already of a platform size, it often makes sense to form a management services organization, or an MSO, which essentially is the business arm of the practice. And usually in most states where there's a corporate practice of medicine law, which prohibits non-physicians from owning medical practices, the private equity-backed investor, or the investors will need to purchase an MSO. They can't purchase the practice itself. So to have an existing MSO that has pulled some of the assets of the practice and the non-clinical assets of the practice into it, that employs the non-physician staff, having that ready is often very appealing to private equity. And again, it reduces their cost. It therefore increases potentially increases the multiple on the transaction. Let's go to the next slide. We'll talk about just some basic regulatory issues. I think of all the regulatory issues, the corporate practice of medicine considerations are the least talked about and maybe the most important. My office is my main office is in New Jersey. We also have an office in New York, as I mentioned. Both New Jersey and New York have recent high-level court decisions that impact corporate practice of medicine. So again, corporate practice of medicine is a regulatory / statutory state set of laws that limit or prohibit non-physicians from controlling or owning medical practices. And it's been historically the case that many business folks have in not only New York and New Jersey, but many states, created what are called captive practices, which is essentially owned by a single physician who might or might not even practice out of that practice, pulled all the assets into an MSO, and operated that practice, controlling virtually everything the practice does via the MSO that's owned by non-physician investors. Both New York and New Jersey have now have case law that makes it really important that you navigate that process very carefully. In fact, my firm we're doing a top-to-bottom compliance program for a large group after a transaction, just to make sure that they're in compliance with the new state law in New Jersey. And there's a very recent case in New York, the Carruthers decision. I think that decision is going to become persuasive in probably many of the states around the country outside of New York. And so I think that conversation, a lot of times what I find is that the attorneys that are working with some of the private equity firms that are these buy-side deal counsel, they're excellent M&A attorneys. They don't necessarily focus heavily on state regulatory issues, and so they often overlook this. And the individuals that pay the price for a violation are the physicians. A corporate practice of medicine violation can affect the physician's license, not going to affect, the license of a private equity investor because they don't have a license. So it's something to consider. There's also obviously Stark and state self-referral prohibitions. And it's worth mentioning the Stark regulatory issue because in orthopedics, if you own ancillary services such as imaging, and you're distributing profits from that imaging center to the referring doctors, you can do that if you meet an exception under Stark. But very often I've found that when the private equity firms come in and they have the regulatory counsel reviewing what's going on within the practice, they often find major problems with the structure. So I think that's something that ought to be carefully reviewed before you go to market, if you're considering this, so that you clean everything up beforehand. And one of the reasons is if the deal goes south, you don't want somebody knowing that you've been in violation of the law for the last 7 years, who no longer has a vested interest in your future, because they could report you, there could be a whistleblower action. So you really want to make sure that you get yourself cleaned up. It's worth mentioning here that the two models that I've seen within private equity, and when it comes to ownership at least, are the friendly PC model and the MD ownership model. The friendly PC model, as we mentioned, is usually what happens is after the transaction, most if not all physicians become employees of the practice, with maybe 1, 2, or 3 physicians remaining owners. Sometimes the physician who's the owner is actually not even associated with the practice. That can be structured in a way that complies with the law, but it certainly creates some regulatory issues that have to be dealt with, and it reduces the amount of control that the physicians have after the transaction, which may be acceptable or not, depending on the deal and the physicians. And the second type is where the physicians retain their ownership, and I'm seeing that more and more lately for whatever reason, depending on the type of specialty. But basically, the physician ownership model allows all the physicians to remain owners, and then what happens is the company enters into an administrative services agreement. We can go to the next slide. So now we're going to talk about negotiating the deal. Now the next slide after this, we'll talk about we can go to the next slide as well. The asset purchase agreement. So the main issues in the asset purchase agreement are negotiating the terms of the purchase price, the terms of the price, and then some of the language in that document, including the representations and warranties. I could spend probably 30 minutes to an hour just talking about this issue, but suffice it to say that as I mentioned before, there's really two factors in determining purchase price. The EBITDA, which is really it is what it is. There's not really a lot of room to negotiate that. There are some things you can do to negotiate it. If there are, for example, one-time expenses that will not recur, you can try to use that to indicate that the EBITDA will typically be higher than it was in the previous year. That's where the quality of earnings report comes in. And then the multiple is really where the negotiation takes place. And that typically is done by the investment banking firm that you retain. It's not done typically by law firms, although as a lawyer I can tell you where I think the ranges are typically at for whether you're a platform or an add-on. Next slide, please. I do want to mention this EBITDA calculation because it is an artificial calculation. If we were talking about, selling, again, a company that sells widgets, it's easy to determine profits, right? Profits are whatever is left over after all expenses, including whatever the executives, normalized executive compensation is. In most medical practice, there is no profit because the doctors take whatever is left after paying expenses. So the only way to generate profit is for the doctors to reduce their compensation through the payment of a management fee to the MSO we were talking about. And the compensation reduction might be 10%, it might be 40%, depending on the situation. The more the compensation is reduced, the higher the EBITDA, and therefore the more the purchase price. And if the multiple is high enough, then a lot of physicians would like to reduce their compensation to zero, and essentially convert all of their compensation into EBITDA, so they can get all the money up front, and then they would work for free for the next 10 years. But as you can imagine, most private equity firms would not do a deal like that because they don't want to disincentivize the physicians from working. So there may be, there's usually, depending on the private equity firm, they have a different tolerance for how much the reduction would be. And it also depends on how much above market a practice is earning per physician. So a practice that's earning, a lot more than market might be able to get a larger reduction down to roughly market, which would then allow them to have a higher EBITDA number. I don't have a lot of time left, but I do want to talk about the external factors we talked about a little before in determining the multiple. We talked about market fragmentation. Payer mix is also really critical. If you have a mostly Medicaid population, that may be less desirable than if you have a very diverse group of private payers. Ancillary service opportunities are really important as well. If you're in a marketplace that could support lab, could support imaging, could support physical therapy, then the private equity investor is going to look at you as potentially a large growth. But what I found, just to let you know, what I found is once one of these deals occurs, the easiest way for the private equity MSO to grow, and that's what they want growth, is to add on new practices. Ancillary services are always available. I don't want to downplay them, but they're a lot more capital intensive in many cases, and they take a lot more time to develop. And there are also payer issues, because a lot of payers will balk at paying for imaging, for example, out of the same tax ID number that where you're an orthopedic practice. But growth is typically where it's the lowest hanging fruit in many cases. So they want to know that you're in a marketplace where there's potential for a lot of growth. If there's a lot of competition for physicians in that area by hospitals, or if a lot of the doctors have already been bought or brought into platforms or hospitals, there may not be, even if you're a very strong practice, there may not be the interest that there would otherwise be. Let's go to the next slide. I'll mention very quickly here, Robert mentioned this too, you're not going to typically be paid 100% cash. They want you to have some skin in the game, so you'll get a combination of cash and then equity in the MSO. And generally, you're not going to get paid all at once. They're going to pay you over usually 2 or 3 years. And keep in mind one important factor that a lot of clients don't consider, which is if you're getting some equity now and some equity a year from now, the equity you get today will be based upon the price of the stock today, and the equity you get a year from now will be based on the price of the stock a year from now. If the company grows, that same dollar amount that you're going to get in stock is going to buy you fewer shares. Just keep that in mind. That there may be some negotiating ability there, but that's pretty much the way these deals work. So you're going to get less stock for the same amount of money a year from now if there's growth. It's important to understand that. Next slide, please. minutes left. Okay. Okay, so I want to talk about the administrative service agreement. I think this is, in some ways, and we can go to the next slide where we get into the details, please. In some ways, this is the more important of the two deals, of the two agreements that we're talking about today. The asset purchase is pretty simplistic in terms of what you're trying to get. There's a lot of negotiation that goes into representations and warranties and things of that nature. But for the most part, you're talking about a purchase price and the terms of the sale. But the administrative service agreement, or the management service agreement, which is an agreement between the MSO that is going to be charging the management fee and the practice, that's an agreement that's going to last upwards of 15 or 20 years. In fact, the term of those agreements is typically 15 to 20 years. So let's talk about what it is really. What are we talking about in an administrative service agreement? As I mentioned before, what happens in these transactions is that the MSO, which is owned typically majority by the private equity firm or a wholly owned subsidiary of the private equity firm, will purchase all of the non-clinical assets of the practice. Now, the term non-clinical assets is a little bit confusing because non-clinical assets, really what they're saying is they're not purchasing the medical practice itself, but they are going to be purchasing equipment. For example, they'll purchase, medical equipment. So it's hard to distinguish between that and what a non-clinical asset is. But they're going to purchase all of the equipment, typically all the furnishings, fixtures. They're going to take over all of the leases, and they're going to employ all of your non-physician and often non-nursing staff, non-PAs. Any administrative staff will be employed by the MSO, leaving the practice essentially as a shell with only the clinical employees remaining there and no other hard assets whatsoever. The MSO is then going to it generates its income through a management service agreement. It's going to charge, in many states where it's permitted, a percentage of the total revenue of the practice as an administrative fee or a management fee, and whatever the actual cost of operating the practice will be paid out of that fee, plus a built-in profit, which is essentially the EBITDA that is generated by this. So the private equity firm is extremely interested in ensuring that they're protected, and this agreement is how they're protected. There will be restrictive covenants that prohibit the doctors from competing against the management company. Now, interestingly, in some states, an MSO cannot impose a clinical non-compete on physicians. In other states, it can. But the non-compete is usually the subject of significant negotiation. We could probably talk about that just alone for about a half hour. The other issue that comes up in these conversations is an unwind. What happens if the MSO doesn't do its job, breaches its contractual obligations, or if the entity doesn't pay the balance of the purchase price? There needs to be some remedy for that. Now, in many of these deals, there is no unwind, and the private equity firms will not negotiate an unwind. In other instances, they will. My personal opinion is that although an unwind becomes very difficult to achieve, it's not impossible because if things don't work out, you could get another financial or strategic buyer to come in and take over the operation. I think it's an important thing to negotiate and consider because I don't think it's outside the realm of possibility. If interest rates go up, if the cost of capital becomes more, it may be difficult for some of the private equity firms out there to continue the growth that they expected. And there's a lot of competition now with insurance companies that are buying practices. Optum, which is an affiliate of United Healthcare, now employs, I think, 70,000 physicians. And next month, it'll probably be 100,000. The growth is extraordinary. So you have a lot of competition in the area. And the last thing that I'll mention on the administrative service agreement is control over clinical and non-clinical employees. The agreement needs to make it clear, who's responsible for determining their schedules, who's responsible for determining their compensation, how are they, who do they report to? Those are things that ought to be in the ASA. I think I'm pretty much out of time. Next slide. Okay, I think I have a couple minutes left. Some other considerations: control over practice decision-making. remember that as physicians, you are the owners of the practice, or your employees of the practice. If there's a billing irregularity, if there's medical malpractice, you're the ones who are responsible for it. If the managed care company claims that there's been false claim, submission of improper coding, or services that weren't performed, it's the physicians that are the front line of that. And therefore, I've always counseled my clients that they need to remain actively involved. They have to at least have a representative that's actively involved in those decision-making processes at the practice level, and not rely entirely upon the executives of the MSO. We talked already about the next thing on the slide, which is private equity commitment to practice growth, adding practice ancillary services. Payer negotiations, I would like to see when my clients get into business with a private equity firm that has experience with payer negotiations and has an understanding of value-based contracting. A purely financial player that doesn't have this experience would need to hire someone that does, and if you don't have them already internally. Next slide. It's one of the last slides, but inevitably when you join a private equity firm model, some of your executives are going to remain executives and may be employed directly by the MSO. Typically, the private equity investors want someone who's savvy at the practice level, especially in a platform situation, to continue to work for the MSO because they're the ones who had the expertise to grow this business, and they're not looking to replace those people. They don't necessarily have those people to replace them with. So I found that there can be some pitfalls when we have a small number of executives at the practice level that are negotiating separately with the private equity firms to take executive positions later on. And here are the 4 areas on this slide that I think you ought to focus on. One is potential conflicts of interest. I believe that what you need to do is fully disclose whatever relationship you have with your partners going forward. I also don't think that you should be negotiating that those individuals that are negotiating positions for themselves, I don't think those positions should be fully signed off on until the underlying deal has already been fully negotiated. Because I think it can raise questions about, did you sacrifice some portion of this deal in order to get a better deal for yourself? So waiting until the main deal is fleshed out, I realize there's some risk associated with it, but my experience is that it results in really the best combination of a good deal for the executive and a fair deal, and the perception of a fair deal by that person's partners. There is inevitably going to be cash compensation. There should also be some equity compensation in the MSO, potentially an option at the MSO level. And another thing that's really important is, and I've seen this happen, is who do the executives report to? The executives report to, who they report to is really critical in determining whether or not that executive really wants that position. They need to understand that it needs to be fleshed out. Otherwise, they get into a situation, they leave a situation where they have a lot of control, and they get into a situation where they find they have very little control. Next slide. I think I'm going to skip this slide because I think we've already talked about most of this, but one thing I'll mention is that there can be a major dichotomy between the goals of older partners and younger partners. That should be worked out in advance, well in advance of even going to private equity. Next slide. I'm going to end here, I think. I think choosing professionals, you just want to make sure that you choose legal, accounting, and banking professionals that have done this before and that understand the issues. And at this point, I think we'll open up for questions.
Yep, we've opened it up to questions. The Q&A box toolbar on the top or bottom of your screen.
It looks like we have one question around autonomy and how do physicians lose autonomy or decision-making in a transaction with a private equity group. So the answer to that really is that obviously when you're dealing with a transaction, especially a majority transaction, there is some loss of autonomy, but the kind of converse answer to that is that typically the autonomy that most physicians are worried about remains untouched in these deals. So When you think about from a board perspective, typically these deals, whether it's 5 board seats, is kind of the most typical. The physicians will continue to have 2 of those seats, and the private equity group will have 3 of those seats, or maybe 2, with a independent third making up the 5. So from a board level, yes, there is some loss of control there, but I think what we find is when the physicians really educate themselves around these deals and talk to physicians that have gone through them, the autonomy of the decision making that they're looking to maintain ultimately stays with the physician. So there's a medical management board that continues to exist post-close in all of these transactions that continues to be comprised 100% of the physicians. The private equity groups can't touch that. And they continue to manage the day-to-day from a clinical perspective, the hiring and firing of employees, the practice management, if you will. And that decision-making stays with the physicians. Whereas the board level, the private equity group, they're focused on growth. They're focused on what area should we expand into, quarterly meeting and deciding, where can we invest additional capital? Does it make sense to acquire that practice that's, 60 miles away, what have you? That's the level of decision making they're looking to assist with. Whereas how the physician practices medicine, do you utilize mid-levels? How do you think about, do you practice 4 days a week? What clinical hours do you hold? Things like that I think when you actually dive into what autonomy most physicians are really talking about, it falls somewhere in that sphere. That remains with the physician. And I think if you really talk to any physician that have done these deals, in most instances, they'll tell you that they were very concerned around autonomy. That's the biggest concern we get. But when you go down the rabbit hole and really educate yourself, you realize that much of that autonomy you're concerned with really does stay with the physicians.
So unfortunately, that's actually all the time we have for today. If anybody asked a question and it didn't have a chance to get answered, or if you didn't even have a chance to ask, feel free to reach out directly to our speakers. Their contact information is directly on your screen. And as a reminder, this webinar will be recorded and it will be distributed later this week. Thank you so much for your time, everyone. We appreciate it, and enjoy the rest of your day.
Thanks.